Exercise 513 Part 1 tells us a story about an air conditioning company that is privately owned, and because they're privately owned, they only recognize bad debt when they actually write it off. It's the direct write-off method. It's the tax method. It's very common for small businesses. But at the end of the year, not the first year, but the end of the year, this company wants a loan. They go to a bank, and banks want financial statements prepared in accordance with U.S. GAAP, which means you must use the allowance method for estimating bad debt. So our first requirement says record each transaction using the allowance method. Now, this does not specifically say use T accounts. I'm an accountant. I use T accounts for everything. So the first transaction says during 18, we installed air conditioners on account for $190,000. So I have $190,000 in accounts receivable and $190,000 in service revenue. My accounts receivable, they tell me it has a beginning balance of $26,000. Okay, so during the year, I put another $190 in there. Part B says we collected $185,000 on account. So we got $185,000 in cash and $185,000 credit to accounts receivable. That leaves my balance in accounts receivable, $31,000. My bad debt expense, if we use the allowance method, is 15% of ending accounts receivable. So I have $31,000. So I need to take $31,000, multiply that by 15%, because that's what they said they were using, 15%. So that's my journal entry. That's what I'm going to recognize. Bad debt expense, $46.50, and allowance for uncollectibles, $46.50. Then it tells me during the subsequent year, all of these were in 2018. In 2019, we wrote off $8,000. Under the allowance method, we always write off to uncollectibles. So we will debit the allowance and we will credit the accounts receivable.